Hi, this is Joe Rabil with Invest Like a Pro. I want to do something a little bit different this time. I've been adding in more and more complex, components to the whole strategy, and I want to continue to do that. But let's go back to the basics, the fundamentals. You always have to focus on the fundamentals before you can start adding layers in. And one of the things I would suggest to you is go and pull up your whatever software you use for charts and take everything off the chart and put two stocks side by side and see if you can't go and identify signals, the signals that we've been talking about, which is a 2 time frame pattern, without the use of anything else. If you can go and identify these trades and where the locations are and where kind of the important, I would say kind of the critical pivotal areas are, I think you're going to be a lot more successful. I'm not telling you to trade this way. I'm saying this is an incredibly important skill set that I think you want to have. So let's just look at this. I think this will make more sense as we go through. I've got the daily chart of Air Products on the left and the hourly chart of Air Products on the right. Now, I'm going to draw in the trend line here. In fact, what I'd like to do is just scroll back and just show, okay, so we were making higher highs and higher lows. One of the things I want to point out, so here's another higher high right here, taking out this peak. So if I'm doing that, I know that the trend is to the upside, but it also allows me the ability to draw in a trend line. Now, I have overlaid the zigzag, the red line here connecting the highs and lows. I have overlaid a zigzag. And on the daily chart, I'm using a 5% zigzag. And on the hourly chart on the right, I'm using a 1% zigzag. So, most softwares do have this. I have referred in the past. This is kind of like training wheels for the trend. I think if you start to see things this way, even if you draw them in yourself, if you started to just connect the highs and lows of the important reversals, I think in your mind, I think you'll get a much better idea of what you're looking for in terms of price structure. So one of the things I wanted to mention, so I've got my trend line in place and I've made a higher high. Now what happens is we start to drop off this peak and we break the trend line. So one thing I should point out, I mentioned the last time that I don't really like entering on a trend line break. And one of the major reasons why is because if you look, most of the time you have a pretty good distance before you break the trend line. If you actually get a trend line break where your last peak is not very far away, then I don't necessarily have a problem entering on the lower time frame, that is, off of a trend line break. But most of the time, I mean, if you look at this trend line break, it's about 20 points away from the peak. And I'd have to put my stop up here if I entered, as an example. And so I just want to kind of to point that out again. It's one of the reasons why I really don't like using trend line breaks for entry. So let's keep going. We're going to go bar by bar. And so here's another key piece of evidence. So I went to a new high on the last swing to the upside, and now I'm going to a new low. So I've taken out the swing high to the upside, and now I've taken out the swing low immediately without any type of swings inside of it. So when I go from a new high to a new low, that is a bear alert pattern. To me, that's something that alerts me to say, okay, the trend, the odds of the trend changing are started to increase because I've taken out the new low, taken out a swing low right after taking out a swing high. So anyway, I thought I'd mention that because I haven't mentioned that in any other videos in the past. And I do think that's an important fact. Now from here, we're going to do one of two things. We're either going to rally up and then come down and make a higher low and then come back up. And that's a failed bear. So it's a bear alert. So it's either going to be a failed bear to the upside and turn back to the upside, or it's going to make a lower high. It's going to rally up, make a lower high, and then make a lower low. And then we're going to have a confirmed bear. So I'm going to keep going. We're going to get a rally up. Now, as this is rallying up, I'm starting to go down to the lower time frame. And I've actually scrolled this hourly chart over so you can see this is about the same time frame. We've moved up for 2 to 3 days, and we've moved up here on an hourly basis for a couple days. I'm going to look at this and say, okay, I've got I've made a higher high, higher low, and now another higher high. I can draw a trend line in place off of this bottom. And I've got that here. Now, immediately what I notice is, the stock comes down and breaks the trend line. So if I'm looking for a 1, 2, 3 change in trend, and I'd prefer to have it in 2 consecutive time frames, if I have that, I've got a pretty high probability that we're going to get a shift back to the downside. So let me just scroll the daily a little bit more. Now we get a little bit more upside, or at least a test of that high, and then it starts to turn down. So I've now got in place a break of the trend line and a rally back up. So I've got 1, 2 in place. 3 would be taking out this bottom. Now let me just make sure you can see. So I'd have to take out that bottom to complete 3. Now again, the way I look at it is I'm using 2 time frames because I want to reduce your risk. I want to get a better entry. I'm trying to improve your timing. And to do that, I mean, for me to go and wait for this to come all the way down, go from 237 all the way down to 213 and then enter, I don't view that as really improving my timing or shortening my risk or reducing my risk or anything. That's the whole reason why I'm going to go down to a lower time frame. I'm going to see if I can't get a change in trend on the hourly chart way up in this area, up in the 220, 230, 232, something like that, instead of waiting for it to come all the way down to break the low on the higher time frame. So let's start scrolling through on the lower time frame and see how this played out. So now I've got the 1 break of the trend line. Now I'm going back to test the high. And if you notice something, we actually come up here and I'm going to put in a trend line right at that peak. And if you notice, just barely, we've taken out that peak, but just barely. And when you break a trend line and then come up and just marginally go to a new high, that is still considered a 2. So I've got a 1 and I've got a 2 in place right now. If we were to reverse to the downside from here, I would view this as the 2 in the change in trend, even though this went to a minor new high. Now, if this thing ran up to 240 or something like that, then I would change the trend line. I would draw a new trend line and I would start the process all over again. But in this case, if you just go a smidge above, it's actually even more bearish than making a lower high, in my view, because a lot of times what happens is you get little people buying here and it creates a little bit of a stronger sense of distribution when it reverses back down. So the stock actually gaps down at this point from that peak, unfortunately, because if it were just to come down straight down through 236 without a gap, I think that would have been a premium entry. You know that you've got a 1, 2 on the daily chart, and on the hourly chart, you're forming a 1, 2 potential 3. So I'm not necessarily going to short this on a gap down in this position. I'm probably going to let this play out a little bit more. And I probably would be watching for another lower high to form. But look what happens. You get another gap down. So instead of taking this entry at 232, now all of a sudden I've got another gap down. And I've sat here studying this. I'm stalking it. I'm doing everything right, but the market's just not cooperating. The gaps, and I've talked about the gaps and everything. It makes it very, very difficult to do this daily, hourly time frame right now. I mean, you could put the trade on. I mean, you could have done it on a rally back up if you wanted, but you're still not getting the actual trigger. So I'd probably continue to stalk. Now, what I'm noticing is I've made a lower high and a lower low now. I actually have only made 1 lower high and 1 lower low. In order to get a trend in place, I really need a second lower high and a second lower low. So, it feels like it's late, but in reality, it really isn't yet. Using a 1, 2, 3 change in trend, I've already got confirmation that the trend is back to the downside. But let's keep stalking this and see if I can't get an opportunity. Now, I've gotten a little bit of a rally and another move back up. and I'm right back into this resistance zone. If I actually can make a lower high without a gap down, I think so. Here we go. Now we've got a bar that's showing a lower low, and I could probably put a stop in up at 232. Now I've got risk reward that really makes sense. Keep in mind something that the lows down here are my target. So, part of the reason why I wouldn't want to do a gap down and risk $8 or whatever is it probably, I mean, you still could probably get 2 to 1. But as I said, when I'm using 2 time frames like this, I typically like to have a target at least 3 to 1. I can now do that in this situation, even though I'm getting in a little bit lower spot. My risk is actually smaller. I'm only risking $4 for a move down to say 214, 215, 216. All of a sudden the risk reward looks pretty good to me. So I would be playing this. Now, one thing I do want to mention, when you put in these trades, I like to give a little bit of room above the peak. I mean, you could put it a couple pennies above, but I think it's a good idea to just make sure that you give it a little bit more room. If a stock typically trades a couple dollars a day, maybe give it, I don't know, 20 cents or 25 cents above that peak, just to give it a little bit of room, just so you don't get nicked out a little bit. So anyway, this follows through. It actually comes back and checks back to the high, but it doesn't take out that high. And then we get a big gap down in our favor, which would have definitely exceeded a 3 to 1 target. So, I wanted to go through the patterns that develop using just price alone. If we go and we look at what's taking place on the moving averages and the MACD, yeah, I mean, we can use these to really help with the timing. If I use this to trigger me in, or wait, this would have been a little bit of a pinch play right in here. I mean, yeah, those are all things that can help. You had the opposing trend develop on the moving averages. So yeah, I'm not saying not to use that, but I think if you can get better at looking at just the price patterns, it's going to dramatically improve. Look for the 1, 2, 3s. Look for the trends. See if you can see the reversals, especially in 2 time frames. And if you can pull that off, I think your both your timing and your entries and everything is going to improve dramatically when you start to add in all the other information. All right. Hit the subscribe button, and we'll talk to you soon.